OG, John AG here. Silver is declining as I speak. It is currently trading at $78 per ounce, down from yesterday's close of $81.88, a 4.7% decline in a single trading day. And while most observers are focused on the falling price, something important has occurred that almost no one is discussing. Comex registered silver inventories have just fallen below 100 million ounces for the first time since the start of this crisis tracking. We are now 16 days out from March 27th, the first notice day for March deliveries, and the trap is being set. Before we examine the data, if you have been following this channel, you know there is no hype and no fear here. We focus on numbers. Today's figures are telling a very specific story. If this breakdown helps you understand what is actually unfolding, hit subscribe and leave a comment with OG John AG. Roughly 75% of viewers still have not subscribed. That engagement is what keeps this content going. Let's get into it. The current price action, silver is trading at $78 per ounce as of midday on February 11th. That is a 4.7% drop from yesterday's $81.88. We are down 35.5% from the January 29th all-time high of $121. Yet we remain 22% above the February 5th crash low of $63.90, and we are still 144% higher than levels from a year ago. This type of movement is not abnormal. This is silver. The issue is not why the price is declining. The real question is what is happening beneath the surface of the price that most people are not seeing. What is taking shape is the setup for March 27th. Gold is trading around $5,030 per ounce. The gold to silver ratio has just widened to 64.5 to 1. At the January peak, that ratio stood at 30 to 1. Each time this ratio widens, it creates mathematical tension. If gold holds at $5,000 and the ratio compresses back to 50 to 1, silver would be priced at $100 per ounce. That is simple math. Bitcoin is at $69,130, down 3.1% today. I have said before, watch Bitcoin. Below $65,000, conditions turn problematic. Above $75,000, conditions are favorable. At the moment, we are in the danger zone. Bitcoin is leading and silver is following. That correlation remains intact. What just happened at the Comex? Here is what is largely being overlooked. Comex registered silver inventory has dropped below 100 million ounces. The latest figures show roughly 100 to 103 million ounces, depending on source and timestamp. But the key point is that the psychological and structural 100 million ounce threshold has been breached. For context, in October 2025, registered inventory stood at 167.7 million ounces. 4 months later, we are at 100 million. That represents a 40% reduction in inventory in 4 months. The current rate of drawdown is 785,000 ounces per day. If this pace continues for 16 more days, through February 27th, registered inventory would stand at roughly 87 to 90 million ounces when the March 1 notice period begins. The March contract currently carries open interest equivalent to 425 to 455 million ounces of theoretical delivery obligations. That is a 4.3 to 1 imbalance. Under typical conditions, 2% to 5% of open interest stands for delivery, which would translate to 8.5 to 22 million ounces. Under normal circumstances, the Comex could manage that, but these are not normal conditions. February deliveries are tracking at a 98% delivery rate. To restate that, 98% of February open interest is demanding physical delivery. That translates into 18.72 million ounces, delivered out of 19.11 million ounces of open interest. This is no longer functioning as a classic futures market. It is operating as a physical allocation system. Participants are using Comex to secure actual metal, not for speculative purposes. If March behaves in line with February, potential delivery demands could reach 200 to 300 million ounces versus expected available inventory of 87 to 103 million ounces. The math does not add up, and the market is aware of this. The trap is being set. So why is silver declining if we are approaching a potential delivery crunch? Because that is how traps function. Here is how the mechanics work. When silver was at $121, sentiment was overwhelmingly bullish. Retail investors were rushing in, margin traders were heavily leveraged, and speculators were euphoric. That is not when squeezes occur. Squeezes emerge once weak hands have been flushed out, when sentiment has turned bearish, and many assume the rally is finished. At present, we are in the shakeout phase. 6 consecutive margin increases by the CME forced liquidations. Kevin Warsh's nomination introduced a hawkish policy narrative. Chinese speculators unwound positions ahead of Lunar New Year. These are technical and structural forces, largely unrelated to underlying supply-demand fundamentals. Yet as the price declines, observe what institutional capital is doing. In a single session in early February, the SLV ETF registered an inflow of 1,023 tons, equivalent to 32.9 million ounces in one day, ranking as the third largest daily inflow in SLV's history. PSLV has accumulated an additional 10 million ounces since November and doubled its equity program to $2 billion on January 20th. Institutions do not typically buy when prices are running higher and excitement is widespread. They accumulate while prices are falling and sentiment is fearful. That is the current backdrop. The trap is being set. The Shanghai signal. Here is another element many overlook. While Western paper pricing is moving lower, the Shanghai premium remains elevated. The most recent Shanghai close was 81.55 per ounce on February 6th, when Western spot was around 72, a 13.7% premium. At the peak of the crash on February 2nd, the Shanghai premium reached 29%. Including China's 13% VAT on physical withdrawal, the effective wholesale premium reached 45.8%. Physical silver in China was trading at roughly a 45% premium, while paper silver in New York was falling by about 30%. And as Western prices continue to slide, that premium structure has not collapsed. It has compressed modestly, but remains firmly in place. This indicates that the physical and paper markets are sharply disconnected. China imposed export restrictions starting January 1st. Only 44 approved firms are permitted to export silver. Silver has been reclassified as a strategic material. SHFE warehouse inventories stand at 423 tons, near decade lows. When the world's largest industrial consumer of silver is restricting exports and maintaining double-digit premiums over Western benchmarks, that does not signal a market that has exhausted itself. For the long-term stackers, about 70% of this audience are long-term physical holders. If you fall into that group, today's price action does not alter your thesis. In many respects, it reinforces it. You are watching paper prices decline while physical premiums remain extreme. American silver eagles are still priced between 95 and 165, representing a 22% to 110% premium over spot. Typical premiums are in the $5 to $8 range. The U.S. Mint has yet to release 2026 silver eagles. They are currently on pre-sale for late February, and dealers are carrying backlogs. The CEO of APMEX has publicly stated that the market is under notable strain. The exchange for physical spread on 1,000-ounce bars has widened to $110 per ounce versus a normal spread of $25. That is a fourfold increase. Silver lease rates have surged from 0.3% to 8% annualized, a 16-fold jump. Such moves occur only when physical metal is scarce, and holders require substantial compensation to lend it. So long-term stackers are adding more ounces at lower paper prices, while the physical market signals scarcity. This is the type of configuration that often precedes sharp moves. The structural deficit is in its fifth straight year. Mine supply cannot easily catch up because 70% to 80% of silver production is a byproduct of other mining, meaning producers cannot simply ramp up dedicated silver mines on demand. Industrial demand is increasing. Solar panels, electric vehicles, 5G networks, and AI data centers are all significant consumers of silver. More than 50% of annual supply flows into industrial applications. That demand does not diminish just because paper futures are being sold. For short-term traders, if you are trading with leverage, this move is either painful or profitable, depending on your positioning. The technical setup is clear. Price is testing support at $72 to $73, which has been the stabilization zone over the past week. Below that, $69 to $70 is major support. A break of $69 points to a retest of the 64 crash low. On the upside, $81 to $82 now represents resistance, and price was just rejected at that zone today. Above that, $85 to $88 is the key region. If price reclaims $85 with strong volume, conditions shift back in favor of bulls. The 50-day moving average sits at $75 to $65, and price is currently below it. The 20-day moving average is at $93, now acting as overhead resistance. The 200-day moving average at $49 to $13 confirms that the long-term bull trend remains intact. Daily RSI is at 42, a neutral but weakening reading. MACD continues to flash a buy signal at 8.96. Though momentum is fading, Williams %R is at negative 100, indicating deeply oversold conditions. Comex open interest stands at 143,180 contracts, down 8.6% from the previous week, which signals capitulation. Weak hands have been forced out. Here's the trade setup. If you are already long and positioned for March, this pullback is largely noise. If you are trading actively, the $72 to $73 band is your key level. A breakdown below that likely points to $69. If it holds, a move back toward $82 to $85 is possible. The larger move will likely emerge once price either breaks above $88 or below $69. Until then, the market remains range-bound. The CPI Catalyst Friday at 8:30 a.m. Tomorrow is February 12th. On Friday, February 13th at 8:30 a.m. Eastern, the January CPI report will be released. It was initially scheduled for February 11th, but was postponed due to the government shutdown. Market participants have labeled it inflation's Friday the 13th. Consensus forecasts are for 2.5% to 2.6% headline inflation year over year, down from 2.7% in December. Core CPI is projected to rise 0.3% month over month. This is the first major inflation reading of 2026. It will either reinforce or undermine the Kevin Warsh hawkish narrative. If CPI prints above 0.3% month over month, the dollar likely strengthens and expectations for rate cuts are pushed out, which is short-term bearish for silver. In that case, we could see a move down towards $75 or below. If CPI comes in soft at or under expectations, the rate cut narrative gains momentum, the dollar weakens, and that is supportive for metals. Under that scenario, a breakout toward $85 to $90 is possible. Markets have already priced in 58 basis points of cuts for 2026, with the first cut anticipated in June. Recent labor data has been soft. ADP payrolls at 22,000, JOLTS job openings at 6.54 million, and jobless claims at 231,000. These figures lean toward the easing case rather than a more hawkish stance. If CPI confirms that inflation is cooling despite weak labor numbers, that is effectively a green light for precious metals. The key is positioning in advance of the data rather than reacting afterward. By the time the number is released, the initial move may already be underway. You are either positioned ahead of time or you are chasing. The March 27th timeline. We are 16 days from February 27th, the first notice day for March Comex deliveries. This is the focal event. Everything else is secondary. Here is how the process works. On February 27th, long holders seeking physical delivery must notify the exchange. The exchange then has the delivery period, which runs through the end of March, to complete those deliveries. Typically, this is routine. Only 2% to 5% stand for delivery, Comex supplies the metal, and trading continues as normal. However, January 2026 saw 49.4 million ounces delivered, that is 7.27 times the 2024 level, and roughly 30 times historical January averages. During 1 week in January, 33.45 million ounces were withdrawn, equal to 26% of registered inventory removed in 7 days. On January 7th, JP Morgan issued 99% of all deliveries in a single day. When a single bank controls 99% of delivery activity, the system becomes fragile. February is showing a 98% delivery rate. If March follows this pattern, even using a conservative estimate where 25% of open interest stands for delivery, that implies 107 million ounces demanded against 87 to 103 million ounces available. There is no margin for error. If delivery demand hits 50%, that implies 213 million ounces. At 70%, in line with recent behavior, it implies 298 million ounces. The registered inventory simply does not exist to meet those levels. That leaves three paths. Comex somehow delivers metal that is not there, settles in cash, or declares force majeure. Any of those outcomes would break confidence in the paper market. I am tracking 3 indicators daily. First, Comex registered inventory, which is updated each evening at 9:30 p.m. Eastern on the CME site. A move below 95 million ounces before February 27th would be critical, and current trends point in that direction. Second, Bitcoin. If Bitcoin falls below $65,000, expect additional selling across risk assets, including silver. If Bitcoin climbs back above $75,000, that would serve as an all-clear signal. At approximately $69,000, we are currently in the middle, and the next move could go either way. Third, the Shanghai premium. If it holds above 10%, that continues to signal tightness in the physical market. If it falls sharply, that would indicate easing pressure. At this point, it is holding in the 13% to 14% range, suggesting the physical market views the paper sell-off as noise. I am also watching February delivery notices. If we see an uptick in the next few days, that would indicate participants are front-running into March, aiming to secure metal now because they are unsure it will be available next month. That would serve as a canary in the coal mine. The bottom line, silver is falling today and could decline further tomorrow depending on the CPI outcome. But Comex registered inventory has just slipped below 100 million ounces with 16 days remaining until the March delivery window begins. The math does not work. The structure is under strain. At the same time, while paper traders sell, institutions are accumulating as much as 33 million ounces in a single day. This is how traps are built. The squeeze does not take place when everyone is bullish at 120 wars. It develops when sentiment is negative, weak hands have exited, and conditions are aligned. March 27th is the trigger date. Either Comex delivers and the market consolidates, or it cannot deliver and the paper structure fractures. I do not call exact bottoms, and neither does anyone else. What I do is follow the data, and the data indicates that the lower prices move now, the more forceful the eventual reaction when supply is unable to satisfy demand. Physical premiums at 110%, lease rates at 8%, drawdowns of 785,000 ounces per day, delivery rates at 98%, Shanghai premiums near 14%. These are not opinions, they are numbers, and the numbers indicate that something is approaching. If this analysis helped you cut through the noise, hit subscribe and comment OG John A. Share this with anyone who needs to understand what is actually taking place. Friday's CPI release at 8:30 a.m. Eastern is the next catalyst. February 27th is the main event. Stay sharp.